So thanks to the organizers again for inviting our paper on the program, and congratulations on the fantastic program. So the title of our paper is Informed Trading and the Dynamics of Client-Dealer Connections in Corporate Bond Markets. And this is joint work with Gabor Pinter, who's hopefully also in the audience today. And of course, the usual disclaimer applies that these are exclusively our views and not necessarily those of the Bank of England or its committees. What's the motivation for writing this paper? So we wanted to measure and compare the role of private information across bond markets. And this is obviously a very difficult challenge because neither the private information nor the identities of the informed traders are typically observable. So in order to identify our informed traders, we rely on the prior order splitting literature, and we use client connections as a proxy for private information. So how do we measure client connections? So that's simply the number of dealers that a client trades with in a given time period. In our case, typically on the daily level. Let me preview the main findings. So client profitability tends to be higher when clients are trading with more dealers. And the effect is typically stronger for information-sensitive clients. So the sophisticated clients, such as hedge funds or asset managers. It's also stronger for more volatile assets. So typically in our case, this would be higher bonds. And also during information-intensive days, such as macro announcements, rating changes, or quite recently, the COVID-19 crisis. And the profits from an increase in dealer connections is larger in corporate bonds than in government bonds. And we have the unique advantage in our data that we can identify clients who trade both in the corporate bond market as well as in the government bond market. And given that this is quite a puzzling result, almost, we use a Carl 1989 model to motivate two hypotheses. So on the one hand, we find in the theoretical model that the higher information asymmetry in corporate bonds should be driving this difference. And this is also something that we find in the data. And the second hypothesis is that the lower interdealer competition slows down the information diffusion in corporate bond markets and could also be driving this difference, but we do not find any evidence for that in the data. Briefly introducing the related literature. So we're related to three strands of the literature. So one would be on the informed trading in corporate bond markets, which is quite a recent literature, but very active. We also touch upon empirical network papers in OTC markets, and of course, last but not least, the order splitting literature, stealth trading, and also the venue choice literature. And our contribution is mainly twofold. So we really focus on the asset level heterogeneity in the corporate bond market and exploit the differences between, for instance, investment grade and high yield bonds. But we also focus on the cross-market comparison. So the comparison between the government and corporate bond market in the UK. To briefly introduce our data, so we use the Zen database, which is a database that is maintained by the UK Financial Conduct Authority and covers all trades in corporate bonds and gilts by FCA regulated counterparties. Our time period is from September 2011 to December 2017, and this gives us approximately 2.5 million trades in around 3,000 corporate bonds. And the main advantage of this data set is, in particular, when we compare it to the trace data in the US, for instance, is that apart from the main trade characteristics that we also observe in the trace data, we also see the counterparties in each trade. So we know when JP Morgan, for instance, is dealing with BlackRock or similar trades. So we have all that information. And we identify 500 or roughly 600 sophisticated investors. So these would typically be hedge funds or asset managers, and then slightly more than 700 less sophisticated investors. These are typically the longer-term insurers, pension funds, etc. So this consistent with another paper I have where we do a similar split. We also have some CDS positions from clients, which we use in one of the tests later on. To briefly introduce the network structure of UK bond markets. So what we typically observe, and this is something that we're really using in this paper, is we have this huge amount of clients. So these clients you see in the outer rim here that deal with the centrally located dealers. And on a given day, a client might be only trading with Morgan Stanley and HSBC, but then on another day or in another bond, he might be trading with HSBC, JP Morgan, Goldman, hence having more dealer connections. Then we also have a interdealer broker market, which is in the center here, which is typically more relevant in the government bond market, in the gilt market, where interdealers balance out their inventories. So how do we measure performance of a client? So we use the signed H-day return here, which is our transaction price subtracted from the average trade price on day T plus H here. So for example, if we were looking at the 3-day performance of a trade that happened on Monday, then we would be looking at the trade-weighted average price on Thursday, which in this case would be 120. So straightforward, when the transaction price was 100, this would yield a 20% return here. Let me introduce the baseline regression model. We look at a 3-dimensional level here. So it's the client day bond level. So we have performance on the left-hand side, as I introduced on the previous slide. And then we have client connections. And client connections is the connections of client I on day T in a particular bond. We also control for the trading volume of client I in that bond on that very day. And then we also have a pretty conservative set of fixed effects. So we have client day fixed effects and bond year fixed effects, which control for some time varying bond characteristics. But to look at the client day fixed effect here, which is very important because it enables us to really look at the within client variation. So for a particular client, when on a particular day, he or she is trading with 2 dealers instead of with 1 dealer, how would that affect the performance in a given bond?
The coefficient that are.
So to introduce the baseline regression results here, we observe on a 5-day horizon a outperformance per added dealer connection here of 2.1 basis points. And this grows after 10 days to even 3.5 basis points. And then we see a slow or a less significant coefficient on after 15 days. So let me show you the graphic illustration here. So what you can see here is that on day 0, there's no tremendous outperformance, which kind of gives us the reassurance that this is not simply about saving transaction costs, but it's really an information story, which is also consistent with the fact that we do not observe a reversal even after a month of trading. And which is important, these results are for our sophisticated clients, so for hedge funds and asset managers. Because when we look at the less sophisticated clients, so our insurance companies, our non-dealer banks, what we observe is a very short-lived outperformance, which is statistically insignificant. Especially when we look at the longer horizons, there's simply no effect. So there is really a strong suggestive evidence that this should be information what we're capturing, really. So in order to test whether it's really information what our connection measure is capturing, we have 8 additional tests. So in order to save some time, I'll just briefly introduce the 8 tests. So we find that the effect is stronger for high-yield bonds, which makes sense because their fundamentals tend to be more volatile and there's more information asymmetry, therefore more scope for informed traders to make money. And then even within the sophisticated investor category, we look at those investors who hold CDS contracts written on the bond issuer, which we think enables them or indicates that these clients are better informed about the fundamentals of this bond issuer. And indeed, we find that the effect is stronger for these even more sophisticated clients. Last, we also look at information-sensitive days. So we find that days with large macroeconomic surprises yields a larger effect. Also, when there's a higher bond price dispersion, rating changes. So a particular interesting case, because what we see is that sophisticated clients are able to anticipate rating changes, and they start increasing their connections before the rating change actually happens, whereas unsophisticated clients do not exhibit such behavior. We also see that the effect is stronger during COVID-19, which I'm going to talk about a bit more in a bit more detail now. So the COVID-19 crisis in the UK bond market was very similar to the crisis in the US market. So what you can see here are the corporate bond spreads during February and March and April in the UK bond market. And as you can see, so the lower two lines are the investment grade bonds, and the upper two are the high yield bonds for the UK and the US market. What you can see is that the development was very similar. And only once we saw the large-scale central bank interventions, so on 19th of March, there was the BOE QE announcement, and on the 23rd of March, the Fed announced the large-scale intervention in bond markets. And only after that, really, we see that spreads started to increase. So this inspired us to look at what actually happened to client connections during that time. And what you can see here, the blue line shows the overall client connections in the market. What's interesting is that on aggregate, we see that connections in the market started to spike before the spread. So it is suggestive evidence that clients were able to anticipate the huge increase in spreads over that time and started to increase their connections accordingly. So we also test that in a regression model, and which is quite reassuring because it also enables us to conduct an out-of-sample test of our main effect. Because if you remember, when I was talking about the data, our usual data set ended in 2017, whereas now we use a newer data set, which is very similar in many features. And what we see is actually that our baseline effect is very, very similar. So this shows us that it's quite reassuring to see that the effect is still there. What we also see is that the effect is concentrated in the peak period of the crisis, as defined by excuse me, Goldstein and others, which is in the second half of March and April. So therefore, we think that there are at least 4 reasons why we're not simply picking up the selling pressure of asset managers, which would be a natural conclusion when we observe this kind of client connection and performance relation. Furthermore, as I said before, we have the client day fixed effect, which would control for all client-specific shocks to their funding liquidity, for instance. We also control for their trading volume in that particular bond, which obviously helps us to rule out price impacts by fire sales as well. We also see that the selling pressure was already present during the build-up and outbreak periods. Nevertheless, there wasn't any significant connection performance relation there. Last but not least, we also see that the effect increases monotonically across the different time horizons and shows no sign of reversal, which again reassures us that what we're capturing is actually really information. We also dive a bit deeper and look at whether the effect is more concentrated around the information-sensitive periods in the peak periods itself. So we look at the pre-BOE and pre-Fed announcement periods. And we do observe that the effect is more concentrated in these pre-announcement periods. And the effect is actually huge. So for instance, if we're taking the pre-BOE effect, so after 10 days, an additional data connection would yield almost 34 basis points higher performance. which then even grows to 42 basis points after 15 days. And we observe even larger magnitudes for the pre-Fed announcement period. The one alternative explanation that has also been explored in the related literature is that the private information could be in the possession of dealer banks. So we have informed dealers who then disseminate their information to their clients in order to improve their client relationships. So therefore, we would typically assume that more connections would mechanically increase clients' access to information and therefore make them better informed as well. So in order to explore that, we also control for daily trading volumes and connections of each dealer. So if we would have a better informed dealer, then this dealer should typically exhibit higher connections and also higher trading volumes in a particular issue. And furthermore, we also add a dealer day relationship fixed effect, which kind of allows us to control for the typical client-dealer relationship that we observe in our sample. So if a particular client, say BlackRock, has a very close relationship to a particular dealer, say Goldman, then we would be able to control for that with this fixed effect. And what we find is that our baseline results remain robust. So we even find some evidence that clients who trade with more connected dealers perform better, which is consistent with the prior studies. So we're not providing opposing evidence, but our story is somewhat complementary to these papers. And the next important part of our paper is the comparison between corporate bond and government bond markets. And our sample has a great advantage that we not only observe the trades of clients in the corporate bond market, but we also observe their trades in the government bond market, in the gilt market. And we use that advantage to run our baseline specification on a merged sample of both corporate and government bond trades, with the important difference that we now have an indicator whether a particular trade was happening in the corporate or government bond market. So this is the D here. And we also have a client market fixed effect, which controls for a market specialization of a given client. Say if you have a micro hedge fund who typically only trades in the government bond market, this delta here would be able to control for that. And what we can see is that the relative connection effects in the corporate bond market here is much stronger than in the government bond market. So this is the line that you're seeing here. So an additional client connection would typically give you around more than almost 2 basis points higher performance in the corporate bond market compared to the government bond market. So this then inspired us to set up a theoretical model. And in the interest of time, I'm going to skip through the setup here and just going to focus on the predictions for our connection performance relation. And the predictions are that the gains from increasing connections decreases as dealer competition increases. This is because when we have fewer dealers, this would typically lead to more bid shading, and dealers would behave more strategically, and therefore this would allow informed traders to profit more from increasing connections.
Robert, you have 2 minutes.
Thank you very much. Second, the gains from increasing connections would also decrease when the asset's fundamental value becomes less volatile. So typically, we would expect that, say, for higher bonds, we would observe a higher connection effect than for investment-grade bonds, simply because the asymmetry in information is much higher for these bonds. And this is also true for the comparison to government bonds. So when we try to disentangle the two mechanisms in the data, what we find is we find strong evidence for the fundamental value channel. So we proxy for that with the rating of a particular bond. So what you see here is a kind of double sort that we're doing. So we cut off the sample at the median number of dealers and also at the median rating. And what we find is that the dealer channel is actually the opposite of what we were expecting. So actually, the effect is concentrated in this group of bonds with more dealers and a low rating, which helps us to rule out the channel that fewer dealers could actually lead to a more pronounced connection performance effect. To conclude, we show that client connection can be used to detect informed trading activity in the corporate bond market. The effect is stronger for information-sensitive clients, assets, and during information-intensive days. And we're also the first paper to compare this informed trading across corporate and government bond markets. And we show that informed trading is actually more pronounced in corporate bond markets. Last, we also have a theoretical model that shows that this difference can be attributed to the more volatile fundamentals and higher information asymmetry in the corporate bond market. So thank you very much for your attention, and I look forward to the discussion and your questions, of course.
Excellent. Thank you, Robert. So the discussant is Or Shachar from New York Fed. While Or is setting up.
I'm very impressed. Let me just share my screen.
So in the meantime, feel free to type your questions in the chat, and I will relay them to Robert when we get to the discussion part.
For some reason, I don't have the share screen up here. Okay.
Great.
Can you see that?
Yep, very good.
Thank you, Bjorn, for inviting me to discuss this very interesting paper. And since I'm from the New York Fed, the usual disclaimer applies here. So first, let me talk about how this paper touched in the big picture of over-the-counter trading relationships. So we observe a large fraction of transactions in the economy are negotiated and settled in OTC markets. Corporate bonds, mortgage-backed security, derivatives are only a few examples of these large OTC markets. In those OTC markets, an investor that is looking to buy or sell an asset first needs to find a trading partner, and then once they meet, they need to negotiate over the terms of the transactions. So we know that these markets are important, but our knowledge on the functioning of these markets is very limited. And it's limited mainly due to the limited availability of transactions data. And this is something that is starting to change. So what we know so far through the empirical work using such data set is that there is large and persistent heterogeneity in the extent to which investors interact with dealers. And we know that trading relationships are persistent and that investors have preferred dealers. And what we also observe is that differences in investors' characteristics, such as information or differences in relationship strength, lead to markup dispersion. So this paper is taking a different angle on that, and it looks on the impact of client-dealer relationships on the client's subsequent performance or the information of the bond later on, depending on their horizons. So they have a UK corporate bond transaction level data that is called ZAN, and it includes the identities of both counterparties for each transaction. So it allows to compare trades on the same client on the same day across different bonds. This should provide a very strong test. And what they find is that clients outperform when they trade with more dealers. They also find that the effect is stronger for hedge funds and asset managers who are viewed to be informationally sensitive. This effect is also stronger for informationally sensitive assets, and it's also stronger during informationally intensive periods like macroeconomic announcements and rating changes. So probably all of you here during the talk and while choosing to see this paper, were thinking that this data is awesome. You want to have this. So if we're going back to the big picture, the view that we have into OTC markets has been limited to the existing data set like TRACE. And as Robert was mentioned, in TRACE, we only observe the identities of the dealers simply because the client identities are not being collected. And even when we have detailed data sets like the DTCC for CDS markets, we can't necessarily carry over conclusion learned from such derivative market to the cash bond market, simply because the nature of the underlying contract is very different. So this paper is the first one to have a full view into the interaction of clients with dealers in corporate bond market. So this is very exciting for us. The baseline result of the paper is that trades executed with more dealers are more profitable than trades executed with fewer dealers. The explanation in the paper is that as informed traders acquire a larger amount of private information, they can make higher profits through splitting informed orders across multiple dealers. So I would just say it out loud, this explanation is certainly plausible. Then to support this explanation, as you've seen through the presentation, they do a lot of tasks in order to support it, maybe too much, to really get this point across. And putting aside all these tests, what is underlying and common throughout the tests is three building blocks. What is a connection? What is an informed investors? And the measurement of this variable that is called performance. And I will touch on each of these three key blocks throughout my discussion. Okay, so this is the first table of the summary stats that they have in the paper. And I feel that for me to understand what constitutes a connection, I need to know what is the market. So this table already skips this and goes directly to measure connections. And there are two definitions in the paper about connection. One definition is that connection is when a client is connected to a dealer bank if it trades with this dealer at least once during the day. And there is another more relaxed definition when a client trades with any counterparty. And you can see that the distribution overall is pretty similar across the two definitions, but there is a slight difference that I will touch in a minute. So what would I like to see before we're jumping into this first table? So I would have liked them to start with some basic summary statistics about the UK market. Amount outstanding, number of bonds, number of dealers. Some of that information is hidden in the text, but it should be more straightforward for the reader to get this information. This is not only going to allow the reader to know what part of the market, if not all, as Robert mentioned, is captured by the data, but it's also going to allow us, the readers, to know whether the conclusions of this paper might be carried over to other corporate bond markets. So given my interest in the US corporate bond market, I was curious and I looked it up. And what I'm showing you here is basically amount outstanding across different global markets. We have the UK over here, we have the US over here. So obviously the size is different. The UK market is $2 trillion, the US market is $10.6 trillion. But not only the size is different, also the composition of the different sectors is different. So the different colors are different sectors. The blue one, for example, is financial. So you can see that the fraction of financial in the UK is much larger than the fraction of financials in the US market. And the reason why I mentioned that, and as well as the other colors are also different, information that investors are going to look for is going to be different for different sectors and different strategies. So as for my question, whether we can generalize the results of this paper to other markets, probably for European markets, we can. You can see that it's different composition and a similar composition and similar size, but I'm not sure about the US market. So for me to get more confidence in that, just fill in something more basic. This is easy to add and will go a long way for the readers. So another information that I need to know, in order for me to know what constitutes a connection, is to know which trading mechanisms are available in the UK corporate bond market. Is it over the phone or electronic trading? If it's electronic, is it a limit order book when people don't know the identities of each other, or is it request for quote? Given that in the first table there is this slight difference between the two definitions, I suspect that there is all-to-all trading going on. And the reason why I'm pointing this out is that in the US corporate bond market, over 20 electronic trading platforms have been facilitating trades. So there are about 30% now of the US corporate investment grade market. It trades fully electronic, and it grew a lot during the last decade, just the period when your paper is covering, the 2011 to 2017. And what some people are not aware of is that there is a type of electronic platform that are actually similar to a limit order book, where there is anonymity in the trading. You only know the identity of who you're trading with at the time of the settlement. And while it hasn't been a lot, like back in 2017, it was close to 3% in this figure to the right here. These days, it's because of working from home, it's actually increased to 10% in terms of volume. Then we see this increase over time. So my question to the authors is, the impact of one additional connection, is it a result of the client's choice to trade in such a venue where you will know you traded with only its settlement, or is it a choice to trade with one more dealer, specific dealer? If you trade on those platforms, you are able to either information, but you don't control per se on the number of connections, and the matching is random. So you don't, like, the +1 is not really +1 because you didn't know that in advance who you're going to be matched with. Okay. So now the second building block is that type of investor that is split between sophisticated versus unsophisticated. The split is actually being assumed. They said hedge funds and assets are decided to be sophisticated, while insurance companies, pension funds, and government entities and others are unsophisticated. So here I'm showing you an expert from a paper about net assets of hedge funds across different strategies. You can see that they are very different in terms of assets over time. You can see also that the potential hedge funds that can trade corporate bonds can be hidden in the credit, in relative value, in the multi-strategies. So there is a variation in terms of the information, the type of information that they would be looking for. It's not going to be a specific, if I'm looking at hedge funds that is doing a relative value trade, it's going to be a cross-market information. It's not going to be to specific bonds. So when we're lumping all the hedge funds as the same type, this seems to be not necessarily a good way to just assume that they're all informed in the same way. Okay, so not all sophisticated, and the same thing is true also for the unsophisticated. They vary by size, they vary by strategies, and they act on different information type. So information about the different types, summary statistics will also be informative, or you can, instead of asserting who is unsophisticated or sophisticated, you can regress investor trading activity measured by volume, number of trades, concentration in a specific dealer, on investor characteristics and bond characteristics, or to use that as a first stage in Ekman selection model. The third building block is this performance measure. And I look at that very closely because at first I wasn't sure what it is, because to me, performance of a trade means that you track the position of a specific client as long as it lives. And then when I looked closely at the definition, what I saw is that what you're measuring is just the change in the price. And so you take the price of a specific trade, J, and then you take the future price average across different clients and different dealers in T days in the futures. And you said that it follows DiMaggio et al. Paper 2019, and so I went back and checked, and there, what they're actually measuring is very matched to in both the price today as well as the price in the horizon. So what they're measuring is actually the value-weighted return of T-day horizon trades executed by manager I, broker J during month T. So the two there are aligned. So in this case, when the two are not aligned, there is another question that popped up in my head. Many of the bonds are not frequently traded. We can also see that in your paper. So what price is actually being used if the bond is not being traded T days from now?
So it's now a bit more than 1 minute left.
Okay, so I'll try to really touch on the last point about the CDS versus bond relationship. The way that the effect is measured in the links of the CDS is they use indicator variable equal to 1 if a client I holds CDS contract, either long or short, so the direction doesn't matter. And then what they are showing is that trading in CDS allows investors to gain an information edge on credit risk fundamentals. So basically, they have this idea that an investor is gaining information in the CDS market and then goes to the bond market and trades there. In a paper that I have with Nina Boyarchenko and Anna Costello, we are actually looking from the dealer's perspective, because those are the common identities that we have in the US market, across the corporate bond market and the CDS market, and we'll look at the probability of their transacting in both markets, and also there are different types of transaction, which CDS contract they're using. Is it single name, index, is it long, is it short? So the main thing for you to see here is the fact, first of all, the bars are very low because it should be probably summed to 1, and most of it is empty years, which means that they're actually not trading in both markets, in both markets at the same time many times. And when they are, it's actually the green and the red bars here that is going to be the ones that are trading in the same week, and it's even a longer window than what you have. They trade in the same week, both in the CDS market and the bond market, in order to express their view. The other bars are actually just a trade in the CDS or just a trade in the cash bond market. And we are also showing how it's changing around post-trading rating changes. So let me just conclude. Very interesting paper. It addresses a very important issue in this literature about trading relationship in the OTC market. The quantitative effect can be very informative for other OTC markets, but for that we need some more context. And about what are the connections, is it direct negotiation or through an anonymous matching platform, who are the informed clients, what is performance that is actually being measured. And once this all comes together, I'm sure that we'll have a first step to solve this question about how do investors choose the size of their trading network. Thanks.
Thanks, Or. That's a great discussion. So, Robert, we have 5 minutes for the Q&A. And if you like, you can start by responding to Or.
Yeah, let me briefly respond to Or. Thank you so much. Really great discussion, and you touched upon many things that we were thinking about anyway, and it is really helpful to get your views on that. So yeah, we definitely work on additional summary statistics. I think you're completely right that currently it's not enough what we're having. Then you mentioned the type of trading. So that's super interesting, because I think, like, the sample period that we're looking at, like 2011 to 2017, it was still mostly over the phone. So electronic trading was really a small part of what was happening in the UK corporate bond market. Recently, especially when we look at the COVID crisis, electronic trading became a larger part of trading volumes. So that's something that we can definitely explore in the data, at least for the more recent data set, and this is super exciting, I think. And yeah, with regard to the types of investors, I think that's also a really interesting point. How do we think about sophisticated investors? Obviously we had to make a cut somewhere, and we opted for this hedge fund asset manager split because this is really, I mean, on the one hand, based on the prior literature as well. So I have another paper with other co-authors where we show that these are really the guys also in government bond markets who are more informed. But of course, it's a somewhat crude measure. But yeah, it's certainly something we are thinking about as well. So thank you so much.